In recent times, there has been speculation about the Federal Reserve's plans to lower interest rates during 2024. This change could trigger a surge in demand for properties, given the already limited supply in the real estate market. Some fear this could lead to a situation reminiscent of the 2008 financial crisis. To better understand this scenario, let's explore how real estate markets function. Simply put, the real estate market involves the buying and selling of properties such as houses, apartments, and land. People enter this market either to find a place to live or as an investment opportunity, considering property prices usually rise over time, leading to potential profit. For instance, in the last 40 years, property prices in the U.S. have multiplied nearly sevenfold. This is why entrepreneurs choose to invest in real estate, buying properties, holding them for a while, and then selling them at a higher price. Most people, however, purchase homes simply to live in them. Yet the majority of Americans cannot afford to buy a home outright with their own income. Instead, most rely on a mortgage loan from a bank. How do these loans work? It's straightforward. Individuals request a loan from a bank to purchase a home. If approved, they repay the loan monthly, which includes part of the principal amount and interest. Interest rates are often based on the home's value, meaning higher property prices lead to higher monthly payments. Mortgages typically last between 10 and 30 years. As of 2022, total U.S. mortgage debt had reached nearly $20 trillion, a 20% increase since 2020. This rise is due to growing mortgage debts and an increase in mortgage holders. The Federal Reserve, also known as the Central Bank of the United States, influences the real estate market by setting monetary policy, including interest rates. When the Fed raises interest rates, a contractionary policy, it reduces the amount of money in circulation. This move makes loans more expensive, leading to fewer loans issued for businesses and personal consumption. Reduced consumption means lower inflation, one of the Fed's primary goals. In March 2022, the Federal Reserve began increasing interest rates to combat inflation, which had begun to rise in 2020 due to government spending during the COVID-19 pandemic. High interest rates directly impact the real estate market by making mortgages more expensive and reducing demand for home purchases. By September 2022, mortgage rates had risen to 6.29%, the highest in 20 years. The Fed's strategy seems to be working as monthly inflation rates have been falling steadily since June 2022. This success prompted the Fed to pause rate hikes in September 2023. But what happens if the Fed decides to lower interest rates? This change could have significant consequences for the U.S. economy, particularly in the real estate market. When the Federal Reserve adopts an expansionary policy and lowers interest rates, it can stimulate economic growth by making borrowing more attractive for businesses and consumers. As companies and individuals take advantage of cheaper loans, there may be a rise in investments and hiring, which in turn can fuel economic activity. In the housing market, lower mortgage rates could increase demand for properties as more people seek affordable financing to buy homes. This heightened demand may drive up real estate prices, creating a hot housing market. However, if the supply of properties cannot keep pace with the surge in demand, it could lead to an unsustainable spike in home prices. While this scenario may benefit homeowners and investors in the short term, it could also pose risks of a housing bubble and potential economic instability if left unchecked. Historically, this is what happened after the 2001 terrorist attacks in the U.S. Lower interest rates spurred demand for real estate, resulting in rising property prices and increased mortgage lending. However, excessive lending led to the 2008 housing bubble and subsequent financial crisis. The crisis started when people couldn't pay their rising monthly mortgage payments and banks began foreclosing on homes. These foreclosures flooded the market with properties, causing prices to plummet. Banks, unable to recoup their losses, faced financial trouble and began failing. The crisis eventually spread worldwide, leading to a global recession. Fast forward to today, and we see a similar scenario emerging. Despite recent increases in mortgage rates, property prices haven't significantly declined, possibly due to a shortage of housing inventory. This limited supply, coupled with sustained or increasing demand, can push property prices even higher. The number of homes available for sale has dropped by 20% in the last 3 years, resulting in a decrease in housing transactions by 26%. With less activity in the housing market, one might expect prices to drop due to fewer buyers. However, prices have remained steady, indicating an underlying resilience in the market. This continued stability in home prices, despite higher interest rates, suggests a strong demand for housing. As the Federal Reserve considers lowering interest rates in 2024, the housing market could face significant changes. Lower interest rates would likely encourage more people to take out mortgages, boosting demand even further and potentially causing home prices to rise sharply. This scenario raises concerns that we might be on the brink of a situation similar to the 2008 crisis, emphasizing the importance of closely monitoring the housing market's trajectory in the coming years. As 2024 approaches, if the Fed reduces interest rates, we might witness another increase in real estate demand and property prices. Given the limited housing supply, this could lead to inflated prices, making it harder for people to afford homes and repay mortgages. The consequences of another real estate bubble could mirror those of 2008. Banks may end up with numerous foreclosed homes they can't sell, resulting in financial distress. This, in turn, could disrupt the broader economy by affecting employment and consumption. In conclusion, while lower interest rates can stimulate economic activity, they can also create risks, particularly in the real estate market. It's important to learn from past crises to navigate potential challenges and ensure a stable economic future. We hope this information provides a clearer picture of the potential impact of changing interest rates on the U.S. real estate market. Let us know your thoughts in the comments. Don't forget to like, share, and subscribe for more insightful content.